We've spent the past 3 years with the economy and the stock market going hand in hand. Just a couple months ago, we had record low unemployment and record corporate earnings, and also a record high stock market. Fast forward to today, and we now have Great Depression levels of unemployment, historically bad corporate earnings, but the market just had its best month since 1987. The moral of the story is some things are just not adding up right now. In this week's video, we're going to be going over the technical imbalances that we're seeing in the markets, the divergence amongst returns throughout the indexes, and lastly, the things that you're going to need to watch for to see if the market is going to fall back down to the economy or if the economy is going to catch back up to the market.
Wealth Management Advisor with this week's market breakdown video. Last week when we took a look at the major indexes, we saw a lot of them failed right at that major resistance zone. And last week they rallied back up for the most part, testing that once again underside of that resistance zone. So it's really important for this week on the S&P 500 is that 2950 to 3000 zone. We're going to pay very close attention to what happens over there. We take a look at the Dow Jones Industrial Average, right? Failed up there at that 24,700 level. Last week rallied up about 4% there off of the lows, back towards the underside of that resistance zone. The Russell, which we talked about, right, failed up at that 1350, fell way back down to that 1250 zone. Last week, rallied back up once again, nearing testing the underside of that major resistance zone. So we're going to pay attention to what happens there. When we take a look at the Dow Jones Transport, same thing. We failed at that 8600 level. We fell back down. And then last week, we rallied back up. This one's still a ways off of testing that resistance from the previous week, about 4% below it. The worst performer being the financials. The NASDAQ banking index actually was flat to slightly down for the week of about 0.1% or so, but you can see really far still off of that resistance zone, about 9% away. Now, we really have a tale of two different markets because what I'm going to show you here is the NASDAQ, and the NASDAQ last week, boom, made a breakout from that major resistance level that we were watching. So from a week ago, the NASDAQ's up about 2.5% from that resistance zone. It's the only one to push through, and it's green on the year and has been extremely, extremely strong. So we really are watching a major divergence between the technology stocks and the rest of the market. And how that plays out here into the future is going to be very, very interesting. So we're going to continue to pay very close attention to that. I hope you guys have yourself a good week. See you next one. Take care.
There were two major news stories last week. First was unemployment, and there were 20.5 million Americans that filed for unemployment last week. That's about 15% of the workforce, and that's the worst level that we've seen since the 1929 Great Depression. Also, earnings continued as the S&P 500 companies reported from the previous quarter, and there was quarterly growth plunge of about 13% last quarter from these companies. Now, even though these were two negative outcomes from the news stories, the U.S. markets continued their rally. So the S&P 500 was up over 3%, the NASDAQ was up 6%, and the Russell 2000 was up over 5% just last week. Now, the Russell 2000 has had a couple strong weeks, but is still down 20% for the year. The S&P 500 is now down single digits for the year, only down 9%. The big story was the NASDAQ, which after this strong week is now positive, almost 2% for the year. There are three pretty eye-opening statistics that I wanted to go over next. The first is that hedge funds and historic investors are holding on to record amounts of cash right now, all while the retail investors' confidence continues to rise. Now, what this means is that the retail investor and the institutional investors are not on the same page, and that's a reason for caution moving forward. Next, only about 20% of the S&P 500 companies are over their 200-day moving averages. Now, if you've watched any of the previous videos that we've done, I talk a lot about the 200-day moving average being either an indicator of a company or an index being either bullish or bearish. So to put that into context, about 400 of the 500 companies in the S&P 500 are under that 200-day moving average, which again is a bearish signal. The third and probably most eye-opening statistic here, the top 5 companies in the S&P 500 make up about 20% of the index in regards to the percentage weight in the index and market cap. Now, these 5 companies have an overall return of about 2.75% on the S&P year to date. This means that the other 495 companies in the S&P have a yearly return of about minus 12%. So to make it a little bit easier to understand, about 20% of the S&P 500 is up 2.75%, while about 80% is down 12% year to date. Now there's one common denominator here with those top 5 companies inside the S&P 500, and that's that they're all technology companies. So if you look back at the returns, that's something that makes a lot of sense because as you can see, the NASDAQ is up almost 2% for the year.
Now that we focused on the markets, I wanted to take a look at the economy, and specifically the US consumer, as US consumer spending makes up a huge portion of our GDP. The first story that I wanted to look at was the prediction made by Green Street Advisors, a leading analyst in the commercial real estate space. And they predicted that 50% of department stores and malls were going to be closed by 2021. Now they cited there's about 1,000 malls left here in the US, and 60% of their space is occupied by department stores. Now this is something that seems inevitable for quite some time, but the coronavirus has certainly accelerated their demise. The retail space has been under fire for years, as sales have moved online and foot traffic has drastically dropped off. But this just isn't a retail problem. This also stems over into commercial real estate, as real estate investment trusts have large portions of their portfolios dedicated towards retailers paying their rent. Now that we're on the topic of real estate, let's talk about the consumer side of real estate, and that's home sales. And a leading online real estate marketing service is predicting home prices are going to drop 2 to 3% nationally this year. The last time that we've seen home prices drop like this was in the '08 financial crisis, and the only other time before that was during the Great Depression. They're also predicting new home sales to drop 50 to 60% in this spring alone. Now, they also said after home sales bottom at the end of spring, they expect a recovery of about 10% per month through 2021. And lastly, probably more important than everything else, has to do with politics. First, we have a phase 4 stimulus package being rumored, with another direct payment to individuals and additional help to small businesses. Second, we have President Trump pushing an infrastructure bill that has an estimated payment of about $4 trillion, which could put Americans back to work immediately. We also need to figure out what's going on with the trade deal with China, as it was put on hold when the coronavirus hit. And with all of the increased rhetoric that the virus came from China and that they were responsible for this, I could easily see where we could be talking about tariffs, not a trade deal. Oh, and by the way, don't forget, we have an election this year. Thanks for watching, and if you enjoyed this content, make sure you subscribe to our channel.